New home sales in the United States just collapsed, and the housing market data overall can only be described with one word.
Ugly picture for new home sales this morning, hitting a 7-month low.
So this begs the question, are home prices about to crash? I'm going to reveal my answer to you in 3 simple, fast steps. Step number 1, let's go over the details of this ugly data that we are just now seeing come out around the housing market. So we go to a chart, today's date all the way back to 2000 roughly. On the left we go from 3 up to 12. What is this? This is new home supply. Remember, the thing that's been propping up home prices over the last 4 years is a lack of supply. So if prices are going to come down, if prices are going to crash, then we have to look for clues in the news, as my good buddies, the real estate guys always say, about supply itself. So what this chart is telling us is the number of months of supply that we currently have on the market. Okay, so 2000, right around 4 months, and going into the housing bubble, or should I say the last housing bubble, it was very low. And as you would imagine, during the GFC, it spikes way up to about 12 months. It comes back down in 2009. It bounces back up to right around 9 months of supply. Very high. I put a red arrow here because I want you to make a mental note. In 2009, when we were right in the middle of the collapse in home prices during the last bubble, we were right around 9 months of inventory or supply on the market. Okay, and then we went down, bottomed out in 2012, and that's, by the way, when prices bottomed out as well. And then we remained relatively low until we get to this point in 2018. Now, what happened here in 2018 going into 2019? That's when Fed Chair Powell started to raise interest rates at the front end of the curve. Now, the front end of the curve doesn't always impact the long end of the curve, but if we look at mortgage rates, we see that mortgage rates did, in fact, go up. So you have fewer buyers, you have more supply, all else being equal. During the cerveza sickness, we all know what happened then. The supply absolutely crashed because the government locked everyone in a cage like an animal and said that you couldn't leave your house. Then what happened in 2022 is we saw this huge spike in supply of new homes once again. Why? Because they started to raise interest rates. And this time, it definitely impacted the long end of the curve. We know the 10-year Treasury went straight up, and mortgage rates did the exact same thing. Now, since that time, we've kind of fluctuated a bit. But what's interesting is now we're right back to a similar level that we were in 2009 when home prices were absolutely crashing. Now, I want to be crystal clear. This in and of itself doesn't mean that home prices are going to come down. As an example, 2022, they didn't go down that much. In fact, they probably went up substantially. But this is a huge red flag that we have to pay attention to, because if this trend continues, if supply continues to increase, at some point it's going to have a dramatic impact on prices. So now let's get into a little more nuance. You saw that clip from CNBC saying the new home sales are getting ugly, the data. So what is ugly? Give me some context there. Well, month over month, we're down almost 14%. That is a huge decline.
Sales of newly built homes dropped nearly 14% in May from April.
And to give you some more relevant information, some more intel here, the actual number was 623,000 sales. Okay, now that sounds like a lot, but the market was expecting 695,000 sales. So this is a huge, huge miss. Because I know a lot of people right about now, your friend and family member Fred, as an example, are going to be saying, oh, George, this doesn't matter at all. This is just nonsense. You need to have more faith in the central planners. And when Jerome Powell comes out and says that the economy is strong and resilient, you need to believe every single word. The only reason we have supply going up is because prices have been going up so much and interest rates have been going up to these sky-high levels, the mortgage rates we're talking about, and therefore you just don't have any demand for buyers. As if that's a good argument for prices not going down. What I'd like to remind your friend and family member Fred is the expectations included every one of his talking points. So the quote-unquote experts out there, the analysts that were expecting 695,000 sales when we only got 623,000, included this into their analysis. Another thing I'd like to point out, editor, go ahead and throw up the charts, is if we go back a year, mortgage rates on the 30-year mortgage really haven't changed that much. And if you look at prices, they're only up year over year by about 3%.
Nationally, the median price of a new home sold in May was $426,600, an increase of 3% year over year.
So this in no way, shape, or form would explain this massive month-over-month drop that we've just seen. Oh, but wait, there is more. Editor, let's go right over to a recent article from CNBC that gives us even more intel on why this new home sales ugly number is such a huge red flag. So like we said, the month-over-month decline from April to May was 13.7%. The sales total was 6.3% lower than May 2024 and well below the 6-month average of 671,000 and the 1-year average of 676,000. Also lags pre-cerveza sickness average in 2019 of 685,000. Now let's bounce over to the aggregate total of new homes for sale, which is 507,000. Just again, going back to that chart that we went over, that's a 9.8 month supply at the current sales rate, which is 15% higher than May of 2024. And finally, CNBC concludes by reminding us these numbers are very consistent with what we saw in 2009 amid the subprime mortgage crisis and the Great Recession. But it's not just about new home sales, which give us a clue as to what's happening with new home supply. It's also existing homes. So if we look at a chart of existing homes, it's a lot better than new homes, that's for sure, but it's still trending in the wrong direction. And before we move on to step number 2, I want to inform the viewers that we've just had some breaking news about the economy that I'm going to reveal in step number 3 that definitely pertains to not only the housing market, but my prediction as to whether or not prices are going to crash. Step number 2. So now let's go over something that is absolutely crucial to predicting whether or not home prices will go up or down in the future, and this is the labor market. Now, most of you know the unemployment rate right now is 4.2%, but once you look underneath the hood, everything changes. Let me show you what I'm referring to. Let's go over to the last report from the BLS. And the reason I'm focusing on the household survey here is because this is how we get the unemployment rate. They don't use the establishment survey. They use this survey specifically. As we look at the data, first and foremost, I want to point out the civilian labor force. This decreased last month by 625,000. 625,000 people left the labor force. So this is a decrease in the labor force, which, all else being equal, would lower the unemployment rate, assuming we had the same number of jobs, but we didn't. The next line I want to focus on is the employed. So this is telling us how many jobs were created or how many jobs were destroyed during the prior month. And if we look, we see it's almost 700,000 jobs. So let me put this in different terms to make sure we're all on the same page. The United States economy has 700,000 fewer jobs right now than it did last month. And the reason you didn't see a dramatic spike in the unemployment rate is because we had people leaving the labor force. Now, I don't know anyone that would say this is a strong labor market, meaning that just because the unemployment rate stayed at 4.2%, even though we lost 700,000 jobs, that this somehow means the economy is strong and resilient. Even if all 625,000 people were retirees, that's fine. They're still going to be consuming, spending a lot less. Their aggregate demand is going to go down relative to where it was when they were actually working. And even when you look at the establishment survey, the numbers are still extremely low, although they're not negative. Last report showed that we increased the amount of jobs by 139,000. This was for May. But if you think about that in terms of an economy of 350 million people, that job number of 139,000 in and of itself is extremely weak. But we're not done there. Let's go over to a recent article from CNBC. And I've been thinking a lot more about how AI is not only going to impact the economy, but obviously impact jobs. So the headline here, white-collar jobs are down, but don't blame AI yet, economists say. And who is it that's able to afford these houses? Who is it that's forming the families that usually in the past could go out and buy a home regardless of, let's just say, a 7% mortgage, or if home prices had gone up? That would be the people that are making the most money, and that would be the white-collar jobs. So if you eliminate a lot of these white-collar jobs moving forward, what is that going to do to the demand for homes? It's going to dramatically decrease. But let's look at the data in a chart and then kind of connect the dots. So we've got monthly job growth in major U.S. sectors. So in professional business services, these are the people that would likely be able to afford homes moving forward, we see that job growth is negative. Construction is actually down. Now, this is really interesting because I wanted to mention this in step number one. I actually forgot. But with new home sales plummeting, what do you think is going to happen to construction jobs? You would assume they would go down as well. And I don't want to go off on a tangent, but I think this is very important for the viewers to realize. I'm going to go over to another chart and just bounce right back. And this is construction jobs. This is a Fred chart. And we can see every single time we get a recession, you have a decline in these types of jobs. Now, I don't know if this is causal or if there's more of a correlation, but you have to assume with new home prices plummeting, we're going to see a decrease in construction jobs. And in the past, that has coincided with a recession. Obviously, if we have a recession, that's not going to be good for the job market. If it's not good for the job market, then it's not good for home prices. But now going back to the CNBC charts, we see that it's not just professional and business services that are in decline or actually showing a negative. It's manufacturing and even healthcare, which is usually the pillar of job growth in the United States, even during a recession. We see that the number of jobs available is declining. It's not a negative number, but the percentage increase is declining. As an example, we go back to June 2024, we're at 4.4% increase year over year, but now we are at 3%. But now let's look at this through the lens of artificial intelligence. You remember the title of the article was AI hasn't hit yet. And I think if you have played around with AI, if you've trained GPTs, you realize that it's not perfect yet, but you see where this is going. And for a lot of these white-collar jobs, they're going to be eliminated. It's not really a matter of if, it's just simply a matter of when. And when they are eliminated, this will absolutely have a negative impact on home prices. So the main takeaways are the labor market is softening. There's no disputing that. And in the very near future, we'll most likely have AI take away a lot of these high-paying jobs from people that would have purchased homes. But does this mean the housing market is going to crash? Maybe, but maybe not. And that's what we're going to discuss right now in step number 3, along with the breaking news that I was referring to in step number 1. Step number 3. So are U.S. home prices on the brink of crashing? Here's my answer. We start by going over this breaking news I've been talking about in this video. Just today, if you're watching this in the future, it still would be breaking news, very recent. We had Q1 GDP in the United States revised down. Now, what's crazy about this is the initial number was a negative, but the expectations were for the revisions, the third and final revision, to show that GDP, real GDP, wasn't negative, it was actually positive. Now, before we go any further, I'd like to remind you that a technical recession in the United States is 2 quarters, consecutive quarters, of negative real GDP. So the revised numbers did not improve. They actually got worse. We were at a negative 0.2% after the second revision, and the market expected that that was going to go up to a positive 0.2. But instead, we went down to a negative 0.5. Oh, but wait, there is more. We had the inventory data come out, and this shows that inventories actually declined. They went down. Now you may be saying to yourself, okay, George, why is that important? I'll get to that in just a moment. And then we saw the deficit, which was expected to continue to go down month over month, has actually gone up month over month, which caught everyone off guard because if you remember the last GDP print, the deficit was huge, but that was because everyone was front-running tariffs. So the idea is that, well, we've front-run all the tariff, we've brought all that demand forward from the future, so this quarter, the deficit is going to improve. And that's very important as well. Let me show you what I'm referring to. We've got this quadrant, and these are basically the components of GDP. So we start over here with personal spending, we'll say. So we've got the average Joe, Moody the millennial, and your friend and family member Fred. Every single transaction, all the money they're spending, that's calculated, and that goes into the GDP number. So this would be a positive. This would be an addition to GDP. But we also have business inventories. So if inventories go up, this also adds money, got the dollar sign right here, to GDP. Well, we've got a third component that adds to this number, and that would be government spending, unfortunately. So we've got your drunk, insolvent Uncle Sam right here. We have the government, and as you know, they're spending like a drunken sailor. So they're spending a lot of money, and that increases the GDP. But we have a negative. Let's move over to the fourth quadrant, and this is actually the trade deficit. So we had the goods deficit come out that surprised everyone by actually increasing at least month over month, when the market thought we would have a dramatic decrease. So remember, if we had a dramatic decrease, that would actually be a benefit, a tailwind to GDP, because this is a negative. Or if we had a surplus, it's going to be a positive, but the probability of us having a surplus is very, very low. So the size of the trade deficit is going to be subtracted from that overall GDP number. So we go back to the initial print for Q1 GDP, and it was negative, but everyone in the market thought that was because we had such a huge trade deficit. And if you would just normalize the trade deficit, the GDP number, the initial number, would have been positive. So the idea was for Q2, this deficit would not only normalize, but it would actually be lower than it typically is, and this would give us a huge positive GDP for Q2 when we actually had a negative for Q1. Now that we're all on the same page, let's go over what really happened. Inventories didn't go up. They actually went down, and the deficit went up. It didn't go down. So let's think about this in terms of overall GDP. This is going to be a negative, a huge negative. This is also going to be a negative. So if all else is equal from Q2, you're going to see 2 consecutive quarters of negative real GDP. That's the punchline based on this breaking data that I just saw this morning. That again is a technical recession. So you've got to ask yourself, if there's a high probability the United States is in a technical recession right now, is that positive or negative for home prices? And before you answer that question, I also want to point out the fact that today the 10-year Treasury yield dropped massively, but the 2-year Treasury yield dropped even more. So what does this mean? This means that the market is looking at these data points and they're coming to the exact same conclusion I am. And that's that the probability just skyrocketed that we're in a technical recession right now. So since yields are all about growth and inflation expectations, the 10-year is coming down, but then the 2-year is coming down even more because that's more so tied to the Fed funds rate. So the market is seeing this as very, very weak and predicting that the Fed is going to cut rates a lot more and a lot faster than Jerome Powell is leading you to believe. And then third, we look at the DXY just confirming this. So the DXY was down big today as well, which is what you would expect when you look at the higher probability for the Fed cutting rates, which would decrease the interest rate differential between the United States and the ECB, or the Fed and the ECB, the dollar and the euro. And the DXY is about 57% euro. So if you have a big decrease in the interest rate differential, this is going to be very, very negative for the USD. So my point here is all three of these inputs confirmed what my conclusion is based on the breaking news, which in and of itself is extremely, extremely bearish for the overall economy, for the labor market, and therefore the housing market. But does this mean I think housing prices are going to crash? No, I don't think so. My base case is over the next 2 years, home prices will come down, especially in real terms when you adjust for inflation. But we had a 50% decline from, let's just say, the peak in 2007 or 2006 to 2012. So do I see home prices coming down by 50% over the next couple years in nominal terms? Probably not. But I wouldn't be surprised if we had home prices coming down by maybe 2 or 3% per year. And if you compound that over 3 or 4 years, that's actually a big number that will decrease aggregate demand in the United States substantially. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.